Do you have clients who have beneficiaries based overseas in respect to the UK? Clients who have children studying overseas and perhaps are concerned how their estate planning can take place? Questions like, do they need to incur more tax, less tax? How would their planning be implicated with overseas beneficiaries, so on and so forth? Are you aware that based on AECC Global Research, the top 3 destinations for overseas education are namely Australia, United States, and the United Kingdom? New research by the Higher Education Policy Institute HEPI and Kaplan International Pathways have revealed that 71% of international students plan to work in the United Kingdom after finishing studies. And make sure you stay till the end, where we will introduce a framework for you to use in your sales presentation. In this episode is Martin, who has been a UK tax advisor for 25 years, where he held a variety of senior roles assisting British expatriates in Europe and the US. He relocated to Singapore in 2011, and in the year 2018, he became the head of tax for a large FTSE 100 wealth planning company, where he was responsible for delivering a market-leading UK tax and succession proposition to private wealth clients. Now, he is the owner and managing director of Spice Taxation, a part of the Spice Advisory Network. Martin has helped many thousands of families with their tax planning and compliance, whether they are British expatriates, foreign nationals with UK assets, people returning to the UK, and resident non-domiciled individuals. And today, he is here with us to answer some questions regarding the UK taxation. Hi Martin, it's great having you here today with us.
Thank you very much.
Now, why don't you tell the audience what you do in exact and what is your area of specialty?
Okay, so for the last 25 years I've been a UK tax advisor, primarily helping private clients with their income tax in the UK, capital gains tax and inheritance tax. I advise people about their property transactions, their succession planning, anything to do with UK taxation for private individuals.
Well, you see, we have an expert on UK taxation in the house, Martin. So I'm going to drill you in the next couple of minutes. In the course of estate planning, we always hear parents or even individuals having beneficiaries who reside in the UK. And because of the cross-border exchange and them living into another jurisdiction, we are crossing to the tax situation in the UK. And that's why, we particularly want to find out more. How would the beneficiaries be impacted when they start to inherit an asset or a payout from a non-UK structure?
Sure.
Right? So, I can understand that in the course of estate planning, wherever we engage a tax consultant, it's like a few $1,000s, and that is like a turn-off to many of the clients. And so hopefully, by today, we are able to glean and share some light into the UK taxation.
I'll be happy to help.
So, first question, Martin, are there any trends over the last couple of years that you have personally observed for beneficiaries that are based overseas, in particularly in the UK?
It's a good question, Eugene. I think, I can't remember where I read this statistic, but it was in a prestigious journal, and it was talking about the fact that 80% of Asian wealth is going to pass down the generation within the next 20 to 30 years. And of course, with so many more people travelling internationally, living abroad, so many people studying in the UK, of course we're seeing a growing interest in the internationalisation of succession planning. And of course, where the UK is connected to that, either because of the settlor or indeed the beneficiary, there's inevitably going to be some fairly major UK tax consequences that follow from that. So, there's a huge interest in legacy planning, transfer of assets down the generation, succession planning, and of course, where there's an international element to that.
That's right.
The UK is obviously always impacted.
Yeah. So, with this amount of wealth transfer, with beneficiaries being more global, I think this is really an essential topic. So earlier when we were talking, you were sharing with me that there are basically 2 levels of beneficiaries, right?
Sure.
So can you explain more? What are these 2 levels about?
Yeah, sure. So if we think about, we've got settlor on the one hand. So this is, the person who might be passing assets down a generation. Here, we're talking about beneficiaries, so the recipients of that wealth. So yeah, you're right, 2 levels. So I guess the 2 categories are as follows. You've got the one type of beneficiary who's in the UK, they're living there, they're resident there for tax purposes, but they don't intend to be there for very long. They might be studying there, they might be on a short-term work posting there, but they know that in a relatively short time they're going to be leaving again because really Singapore's home. There's a second level of beneficiary, which is where you really get the complicated tax issues, who perhaps having gone to the UK, they have started to settle there. They might have studied there, got their first job there. The job posting, well, they really like the UK and they want to stay, and they meet someone, they have a family and they settle down, and eventually they're long-term residents of the UK, potentially also with the intention of remaining permanently. And that happens a lot, actually. I come across many Singapore clients here who have kids who have gone to the UK, they've studied and they've just stayed. And that's really where we need to focus very carefully, not only on the beneficiaries' tax planning, they're residents in the UK, but on the steps that the settlor can take in order to create tax efficiencies intergenerationally. And that's really where it gets very interesting for me.
So from what I understand from you, Martin, it really depends on the intention, whether the beneficiary would like to reside there for long term, to set up their family, have a long-term employment, right? But what if like, a beneficiary is not sure? You know, I'm sure many Gen Z or Gen Alpha, when they head over to the UK, it's like YOLO, you know, you only live once. So they find a job for 5 months and then they stop working for 2 months. So how do you distinct whether are they there for the long term or not?
Yeah, good question. So look, there's a tax answer here. And you know, it's based on a couple of foundational concepts. So we don't need to define the concepts, but it's basically residence and domicile. If you live in the UK, you're tax resident and you have some tax obligations that flow from that, whether you're there for a short time or whether you're there forever. If you form the intention of settling in the UK permanently, then you fall into that level 2 category. So, you know, how does that happen? You either just say, look, the UK is going to be the centre of my world forever. So you become domiciled in the UK as well as being tax resident. Or for UK tax law purposes, once you've gone through 15 tax years as a resident, from the start of the 16th year, you fall into that second category.
Whether you like it or not?
Whether you like it or not.
Oh, wow. So
no choice in the matter.
Right, so here we go. The first principle, whether you are a resident or your country of domicile is in the UK, the rule of thumb is actually that 15 tax years.
Yes, correct.
And what happens if someone goes through like 13 years and then there's a break, you know, they leave UK for 1 year?
Good question. In order to break that cycle, you need to be non-resident for 6 consecutive UK tax years to break that cycle.
To break that cycle, you need to be 6 years.
And that's tough if you've settled there and you really like it. And you kind of want to go back. So being away for 6 complete and consecutive UK tax years is a big deal.
Right, okay. Yeah, thanks for sharing that. I think most people, you know, even for financial consultants who are listening in, don't really know the magic number 15 years. And so 6 years, right?
15 years in, it's got to be 6 years out to break the cycle. And of course, whilst 15 is the magic number, at any time before that, if you know the beneficiary says, you know, goodness me, this is where I want to be based for the rest of my life will always gravitate around the UK, then they fall into category 2 from that earlier time. So in that sense, it's intention driven as well. And
that forms into the second level, which is the country of domicile in the UK.
Correct, yeah.
Wow, okay, let's
You've done your homework, haven't you?
Let's throw an example, right?
Okay.
So let's talk about Mrs. Tan, who is a Singaporean, who has assets based here in Singapore, and she's worth $10 million. Tell us more in this example. How would the beneficiary who's a UK domicile, level 2 domicile, you know, have their taxes eating into the inheritance? Like, give it an example.
Yeah, sure. Let me flesh the example out. So Mrs. Tan, she's Singaporean, she's never lived in the UK, she has no assets in the UK. Her only connection to the UK is her only daughter, that's Sarah. Sarah is married to, I don't know, Bob, who's British, Bob the British man. And they've got 3 kids. So she's been there for donkey's years. And let's flesh on the bones. She studied, she did her medical degree in the UK, she got her first job in the UK, met Bob, settled down happily ever after. UK. So Mrs. Tan over here, 10 million Singapore dollars. Let's say 4 of that is in her main home, and 6 is in a portfolio of equities here,
Yep.
SGX listed. So when Mrs. Tan passes away, there is no UK tax payable whatsoever. Why would there be? She's got nothing to do with the UK. The assets are outside of the UK. But without planning, obviously everything then goes to Sarah.
That's right.
And from that point onwards, Sarah will be charged tax on the income and the gains that are generated from the investment portfolio and the property if she rents it out. So if you think about a 6 million Singapore dollar investment portfolio, let's just say dividends generated of 200,000 pounds equivalent and capital gains of 120,000 pounds. That will add just a little bit less than 100,000 pounds to her income and capital gains tax bill in the UK annually. Of course, she's happy. She's got a $6 million portfolio, but she's having to write a cheque for another £100,000 in tax each year. If she then passes away without planning, that 10 million Singapore dollar portfolio, let's call it £6 million.
That's right.
Without planning would generate an inheritance tax exposure of £2.4 million. So a flat rate of 40%. So we then translate that back into Singapore dollars. Mrs. Tan, who had nothing to do with the UK at all, $10 million estate, her grandchildren, who she cares passionately about, what they get is a little bit less than 6 million. I think it's 5.3 million Singapore dollars after the inheritance tax.
When Sarah passes on subsequently.
Correct, because Sarah's going to be there forever.
Right.
Now that's a horrendous example. It's an example without planning, and we never want to allow tax to happen to us like that.
Yeah.
But it just illustrates. This lady who had nothing to do with the UK, all she wants to do is pass on this hard-earned wealth intergenerationally, to land with the grandchildren. Suddenly 40% of that goes to the UK taxman.
40%?
With income and capital gains tax on the way.
But I understand there's a threshold that is non-taxable.
That's correct.
And that is only like 325.
That's correct. So when Sarah passes away, she'd have a £325,000 allowance, unless she's used it already.
Which is not a lot.
No,
right?
it's nothing.
For 6 million worth.
And then it's a flat rate of 40% after that.
Right.
Full zero. It's almost incomprehensible.
And what happens if you don't pay up?
You go to jail, I guess.
You go to jail?
Yeah.
Has that happened before?
Yes.
Oh, wow. Okay.
Yes.
So that means that there's some planning that needs to be done?
Yes. I mean, she could flee to Singapore, but then the UK government would contact IRAS, and IRAS would collect the money.
IRAS will collect the money on behalf?
They would, yes.
Based on the tax treaty?
There's something called the Mutual Assistance in the Recovery of Tax Directive that's been signed by lots of countries.
So in other words, you can't get out of it. You can't get out of it. Your estate is liable.
Correct. Yeah.
Wow.
So without planning, if as a tax advisor, I never want tax to happen to my clients. You have to plan for these things.
Yeah.
And reasonably anticipate scenarios, and of course, tax is vitally important, but there are perhaps more important things like how you want to live your life and where you want to live, so on and so forth. But my job as a tax planner is to sit down with clients, establish what do they want. Forget the tax. What do you want with your life? How do you want to live your life? And then you tell me that, then I can tell you how to do that tax efficiently as far as the UK is concerned.
Right.
So we always want to be looking at planning wherever it fits in with the client's wishes.
Right. Great. So that is good stuff. Let's revisit. Let me just rewind a little bit when you mentioned, the earlier example where Mrs. Tan, she has 10 million.
Yes.
6 million is actually in a property and 4 million in investable assets like shares, whatnot. And you talk about the income, right? So income that is actually passed on to Sarah,
yes,
which has to be filed under Sarah's personal income tax.
Correct, in the UK.
At the tax bracket that she is liable at.
Yes.
So what happens if it's payable via capital? Because we are always talking about the difference between income and capital.
Yes.
Could you share with us more about that?
Absolutely. So we'll probably get a little bit technical here. So Sarah, she's liable to pay tax on worldwide income and gains. So the distinction between interest and capital isn't relevant. She's taxed on whatever income and gains arise. And she get credit for Singapore tax paid on rental income and things like that. But if you're a level 1 beneficiary and you're domiciled outside of the UK, the distinction between income and capital can be very important, because when you bring money into the UK, you're only taxed on the income and the gains you bring in, but the underlying capital can be brought in tax-free.
Yeah.
But that's not Sarah's position. She's domiciled in the UK now, so she has no choice. She must pay UK tax on worldwide income and gains.
Right.
Now, it's only income and gains she pays tax on. It's not underlying capital. There is, thankfully, the UK doesn't like to tax underlying capital for income and capital gains tax purposes. So she has no choice about that.
Right, I see.
So the remittance basis, the distinction between income and capital isn't important in that case.
Right. And earlier you were sharing that the income is only taxable if it's being brought in, say for example in Singapore, to be brought in into the UK.
Yes. So let's think about our level 1 beneficiary, the person who hasn't settled, so not Sarah's case, the person who's not settled permanently in the UK. As far as they're aware, yes, they're in the UK, but they're going to leave at some point.
Just a tax resident.
Just a resident.
Right.
Originally from Singapore, they've decided to make the UK their permanent home, so they are domiciled in Singapore whilst also being resident in the UK. Now, at that point, the question of remitting or transferring wealth into the UK is important. So basically, someone in that position has the right, unlike Sarah, to elect to keep their foreign incomes and gains outside of UK tax, provided that wealth is not brought into the UK or enjoyed in the UK. And that's called the remittance basis.
So as long as the income is not remitted into the UK, not being enjoyed by Sarah in this example as a tax resident.
Well, Sarah's a class 2 beneficiary. She's domiciled. We're talking now about the more shorter term transient person.
Level 1
level
tax
1,
resident, right? So what about, okay, let's take for example, a parent in Singapore, nowadays with global transfer, it's so convenient to just transfer maybe a small token, 50,000 for the beneficiary's birthday in the UK. So they just go on to the internet banking and they just remit 50,000. Now, is that considered taxable?
Great question. So it depends. In tax, the answer is always it depends, right?
Great
always. It is though. So look, we have to ask the question, is it a gift from the parent, or is it being paid out of income and gains that belong to the beneficiary in the UK? If it's a gift from the parent, it's a tax-free remittance. It's just a gift. There is no tax on gifts in the UK, on the receipt of gifts.
Right.
And there's no inheritance tax to think about because the donor or the parent is in Singapore, domiciled Singapore, it's Singapore money. So there is literally, in that case, in the case of gift, there is no UK tax consequences on the beneficiaries having made the gift or on the donor. Of course, the beneficiary then has £50,000. They might invest that, make money with it. There's lots you can do tax efficiently in the UK with money, probably outside of the scope of this conversation. If, however, the beneficiary has generated income and gain, so for example, they've been in the UK for say 5 years, they've rented out their Singapore property, that's generated some rental income, and that is brought into the UK, then they pay tax on that when it comes in, to the extent it's matched to the income that's been generated.
So if there's a rental income being collected in Singapore, and the money is being remitted to the UK tax resident, the beneficiary,
correct,
they need to declare tax. Because it's being remitted.
And they get a credit for the Singapore tax already paid, so that's good. There's no double taxation. So you have to think, so that's the case where the beneficiary already owns the asset and is generating the income. But in the case of a parent giving money, their own money, no UK tax consequence on that.
Okay, so what happens if a parent, for example, travels, now we can travel once again, and travels to the UK and buys maybe some expensive watches. Right, 200,000, 300,000 worth. Is that taxable?
Okay, so again, you've got parent in Singapore, UK resident child.
That's right.
Parent says, I'm going to take £50,000 of my own money, I'm going to buy a Rolex for little Willie who lives in the UK.
That's right.
Right, it's a gift. No tax on remittance. No tax on remittance. If the UK resident had, say, stored up £50,000 worth of Singapore rental income and decides to go abroad and buy a Rolex with it for himself, and then goes back into the UK wearing that Rolex, that's a taxable remittance.
Oh, can you repeat that again?
Yes. So if it's his own rental income, so he owns a property, so a UK resident owns a Singapore property generating rental income, money stays in Singapore, so no UK tax.
Yeah.
He goes out, comes to Singapore, goes down Orchard Road, buys a Rolex, and flies back into the UK. The moment he enters UK airspace, that's a taxable remittance of that money, even though it's rental income expressed in the form of a Rolex watch.
Right.
So this concept of remittance is actually being defined very, very broadly in the UK.
Okay.
Very broadly. For example, you might decide to use your Singapore credit card, your Singapore debit card to pay for example, your UK house insurance. Well, that's a remittance.
That's a remittance, right?
Yes, it's enjoyment in the UK.
Right.
It's effectively paying for goods and services in the UK using that money.
Yeah.
If he were to want to borrow some money in the UK and he were to secure a mortgage on the Singapore property and that money comes into the UK, remittance.
Remittance.
Yeah,
and
so
it's taxable.
Taxable, yes, if to the extent that it's matched to income and gains that would be taxable if remitted.
And I think
complicated, isn't it?
you brought up you brought up a very good point about the remittance basis when income is actually being remitted or brought in, or even in this case purchased using a credit card.
Yeah,
it's considered taxable, right? And I think this gives rise to the usage of discretionary trust in nature, non-UK trust, for example, set up in Singapore by parents who have children in the UK. So it's a good tool for intergenerational transfer because it doesn't get to pass through Sarah and Sarah's kids.
And interestingly, all the benefits of a trust generally, the avoidance of probate. For example, when someone passes away, and asset protection. What if Sarah and Bob divorce? Well, it doesn't matter in that case because Bob's not beneficiary of the trust. Right.
So you are saying that in a trust, in a discretionary trust, it offers not just some tax benefits, it also offers some form of protection.
Organisational benefits, no need to get probate over the assets. The trust just continues.
In the event of a divorce of Sarah, who is in the UK?
Correct. And if Bob is not a named beneficiary, well, the assets are owned by the trustees. They don't belong to Bob or Sarah, so they can't really be taken into consideration as part of a separation of matrimonial assets.
Right, and the trust is able to stipulate like how much to be, net of taxes to pay off to Sarah.
Correct. Yes. So Mrs. Tan in this case would express a letter of wishes.
Right.
What are the circumstances in which I'm happy for monies to be distributed from my trust? Under what circumstances am I not happy? What types of spending am I happy to endorse? So, little grandchild.
All your wishes in the letters or wishes in the trust deed.
Yeah. For example, if grandchild William wants to go and buy a Porsche when he's 18, that's probably not something she wants.
Right, right.
She gets to stipulate that though.
Right. So that's what we usually tell clients as well. In the trust deed and in the letters of wishes, you can actually stipulate how would you want the money, the inheritance to go to your beneficiaries and your beneficiaries, your children's children.
Yes.
Right, so that you can exercise certain due diligence.
Yeah.
Right.
Absolutely.
Martin, you were just sharing that there's another tool that we can use for tax planning. Would you like to share with us?
Yeah, of course. I do an awful lot of repatriation planning for clients. And a lot of them are not of British descent. So we always have to think trusts for inheritance tax purposes, but how do we get income to these people without having to think about this remittance basis of tax? Right. So we're not triggering tax on the remittance of money. So for that, you'd use something that we know in the trade as an offshore life assurance portfolio bond.
An offshore life insurance portfolio bond.
Correct. Now, what does that mean? It's simply a portfolio of units and funds. It can't be shares. It's got to be units and funds that are held with the custody of a life company. Right? So that allows the structure to fall within a different part of the tax code. But in essence, what you can do is draw out of that 5% of the amount invested per policy year into the UK, and that is free of tax year on year. So it's a way, so Sarah, for example, in our example, she's a doctor, earning good money. She doesn't need the income and the gains. So it rolls up in the trust. when she stops being a doctor and retires, that's when we switch the trust income stream on from this type of structure, and 5% of the amount originally invested in the trust can be passed to Sarah per policy year as a non-taxable stream of income. So a non-taxable stream of income coming from an inheritance tax exempt source. Now, it's not a silver bullet. There are circumstances in which tax can apply in that situation, income tax. But in essence, we've got a long-term stream of income that Sarah can enjoy without having to even put that income on her tax return.
Great. So you're saying that in essence, usually income that's being remitted is being taxable.
Normally, yes. Yeah.
But if one were to set up in his or her lifetime into a life insurance wrapper, we call that.
Sure.
Right? So up to 5% of the yearly distribution.
5% of the amount invested.
Of the amount invested, it is non-taxable.
Correct.
Even it's being remitted into the UK.
Correct.
That's awesome. That seems like an effective planning.
That works for Sarah, Class 2 beneficiary. It works for Class 1 beneficiaries who are taxable by reference to what is remitted. And of course, Sarah will have built up her own wealth outside of this structure in the meantime. She'll be doing her own tax planning domestically with that. So she'll probably have some pension income. She'll be using her tax allowances. But this other income delivered to her tax-free allows to have a much higher level of income without paying high levels of tax.
So you do not necessarily need to pay a higher tax bracket just because of that 5% income that comes in yearly.
Yeah. And let's just think about her mother, Mrs. Tan, then. So she's got choices about when to set this trust up. She could do it in her lifetime, which is absolutely fine for the investment account, or she could do it on her demise. The Singapore property, obviously, I don't think you'd put the Singapore property into trust in her lifetime, because otherwise there would be stamp duty.
That's right.
So that should go in on her demise. But the sooner she establishes the trust, in many respects, she's got peace of mind. She can control. She can be a trustee. She can appoint a protector. She can get the thing working, familiarise the family with it.
Right.
There's no right or wrong answer in terms of timing. So
one of the good usage of such a tool in your lifetime is that, let's take for example Mrs. Tan, who represents some of the Singaporean parents here in Singapore. If they should set up such a tool, they could use the payouts in their lifetime as a form of retirement.
Absolutely right.
And the moment when they are demised, when they're gone, that portfolio continues to run, and the income up to 5% will be given to Sarah, who's in the UK, and there's absolutely no tax.
Correct. Obviously, in our example, that equity portfolio, 6 million Singapore dollars, well, where else is she getting her income from? She's getting it from that portfolio.
Yeah.
She must continue to benefit.
That's right.
So she'd put that $6 million portfolio into trust. Now, when Sarah eventually draws on it, it's 5% of 6 million. It's not 5% of what it grows to, so it's not a silver bullet. It's the capital. But Mrs. Tan can be a beneficiary. Right. And she ceases to be a beneficiary when she passes away. In fact, she'd probably be the main and only beneficiary during her lifetime. But there's also, part of a controlled and sensible succession of assets is working with your beneficiaries, familiarising them with what you've done, why you've done it, getting them comfortable with it.
I like that point. Working together with your beneficiary.
It's really important. Really important. And it allows. Families usually are invested in each other, aren't they? But it allows for a much more open dialogue. Now, the personal financial matters are often quite private. People don't always share. But if she wanted to, she's come in, Sarah, be a co-trustee with me, so you can see how this works.
Co-trustee. I like that.
Or be a protector. Or if I lose my capacity, I'm getting old and I start to lose my mind, well, at least I know I've got you there as a co-trustee.
That's right.
Because you know what I want. And it allows Sarah and Mrs. Tan to have a really healthy conversation about desires and wishes. Controlled, sensible succession of assets. Of course, you could just do it all at death, and that's also fine. There's no right or wrong answer.
All right, coming to the last question. Awesome stuff, right? What about a parent or an individual in Singapore? We have been talking pretty much about assets located out of the UK.
Yes.
And that's why we talk about the remittance basis. What about a typical Singapore parent having a property in the UK.
Yeah, and it doesn't necessarily need to be a parent, does it? It could be anyone.
Anyone.
Yeah. So different class category now, isn't it? So we've been talking about the impact of having someone resident in the UK with foreign assets. Now we're talking about a Singapore resident, not UK resident, with a UK asset. So it's
a UK asset, that's right.
So it's property. Extremely common asset class, of course, and there's a really evolved market here in Singapore for the acquisition, particularly of off-plan property all around the UK. In fact, I've acted for hundreds of Singaporeans in this capacity over many years. So a few things. When you buy property, you've got to pay stamp duty. Fine. That legislation has evolved. We have non-resident stamp duty. We have additional rates of stamp duty. It is what it is. You can't really plan for it. You rent the property out. You have to pay income tax on your rental income. Starting at a flat rate of 20, and then once you've hit a certain threshold, it can go to 40 or even 45%.
45%?
In the extreme. You have to be earning about $280,000 Singapore dollars of profit before you hit the 45% rate, but it's still, that's eye-watering, isn't it?
Twice of that in Singapore,
right?
yeah. It's crazy. Yeah.
But most people with modest portfolios, it's 20%. So,
20%.
So income tax, you have to file an income tax return. That's a very simple thing to do. The IRAS equivalent in the UK, they call them HM Revenue and Customs, Her Majesty's Revenue and Customs, has a very good, very well-written website. It's information overload, but it is certainly not beyond the wit of man for a Singaporean to learn how to file a UK tax return, or you can ask someone like me to do it, of course.
Of course.
When you, if you don't rent out your property, there's no tax to pay except council tax, right? So that's just like your equivalent of local property tax here. When you either give away or sell, or assign an interest in that property to someone else, you have to pay capital gains tax. And capital gains tax, you have an allowance for that, £12,300 per person. And the rate of capital gains tax is either 18% or 28%. The UK government will only tax the part of the gain that has actually arisen from the 6th of April 2015 for directly held residential property, or the 6th of April 2019 for indirectly held property or commercial property. Then we have, obviously we've talked about inheritance tax as well. It's a UK situated asset. The UK government is certainly interested. If you pass away with that property in your estate, you have an inheritance tax allowance of £325,000. If you have debt, that debt may not be deductible. Not all debt is deductible. So I talk a lot to clients about inheritance tax planning with UK property. There are some solutions that are workable and reasonable.
Right.
I'm quite often asked whether it is better to buy in the name of a UK company or an individual, and the answer, always in tax, is
it depends.
It depends.
You got it?
It depends. That's why people like me exist, right? Because it depends. Generally speaking, there's a little bit of an advantage in using a company, and that advantage can become very compelling if you have larger portfolios.
Okay.
So I'd always recommend that a UK property owner has a UK will. The UK will recognise the Singapore will, but it takes a lot of time and it costs a lot of money. It's so easy, just get a UK will.
Yeah. So in other words, if you have a property in the UK, you should have a UK will to distribute the property, and the valuation of the property upon the client's demise, is subjected to 40%.
It's inheritance
Anything
tax.
that's above the threshold of £225.
Yes. I would say there are 3 exceptions in that situation, and this is kind of a bit amusing.
Okay.
The first exception is if the property transfers to a surviving spouse. Inheritance tax is not a tax on marriage.
Right.
So if there's a Mr. and Mrs. Tan and Mr. Tan passes away and his half share goes to Mrs. Tan, no inheritance tax.
Okay.
The second exception is if they decide to give that property to a UK charity.
To a UK charity?
Well, you might. That's not inconceivable. But what is inconceivable is the third option, which is, funnily enough, if you decide to give it to a UK political party, that's exempt too.
A UK political party?
Now, I wonder why they wrote that into the law.
Okay. That's a separate topic altogether. We can do
let's
one.
not go there.
All right. So here you have Martin, who has actually, brought us through the whole chain of actually how a UK resident and a UK domicile beneficiary, it's able to actually plan through in terms of tax inheritance.
Yep.
And I just want to add on that every family is different. We will not just take
Of course,
this interview as a legitimate tax advice, but if you want to find out more and if you have a beneficiary in the UK, feel free to contact Martin, and Martin will actually be able to provide a complimentary exploratory session so that he can actually lay down the parameters for you to consider before you decide to take it further or not.
Yeah, and I am based here in Singapore and have been for, I don't know, 11 years now. So,
wow, and,
so of course I'd be delighted to help, and do feel free to reach out. And thank you so much, Eugene. It's been great fun.
You're welcome, and you know what? Martin is certainly someone you should speak to. He's based in Singapore and he speaks a little bit Singlish. Try it if you want to.
No.
All right.
Thank you very much indeed.